Hi everyone, my name's Stuart McGilvray, and what I hope to do is put together a series of YouTube clips for people. Um, the main reason, I suppose, is to give everyone an idea about different financial planning topics and just give them some, I guess, basic understanding of why they would need to address these issues in their lives. The one I wanted to start with today was um, insurance and making sure that you're protecting your family, yourself, and your friends and everyone else around you in your life. Quite honestly, there's not enough people with insurance here in Australia, and I think it's one of those things that quite often it doesn't get spoken about. Maybe people have I guess there's a bit of awkwardness about why they wouldn't want to do it. They just feel as though they're Superman, and maybe they just don't think it would ever happen to them. But there wouldn't be too many people that would be out there that haven't had their lives affected by some form of illness, whether it be an accident such as a car accident or even an illness like a heart attack, stroke, or cancer. So, what I want to do today is make sure that we can run through some of those or the reasons why you would have insurance and just clear up some of the misconceptions people may have with insurance and yeah, see how we go. So I'll run you through this slideshow. I guess as we go through, I'll address points as we get to them. Here's the agenda. What I wanted to cover off on today was, first of all, what your most important asset actually is, the types of insurance that are out there, why you need it yourself, the different ownership mechanisms that you can look at for owning insurance, and then finally just to summarize the need for it and why it's appropriate. So I suppose in terms of what your most important asset is, a lot of people feel it might be their house because they've invested so much money into it. It could be their car, it could be a whole range of things. The reality is it's actually your income and your ability to earn income. So without your ability to earn income, there won't be any more cars, there won't be any more houses, there won't be any more discretionary items for you to purchase because basically you won't have any more money to keep funding all your different expenses. So it's one of those things. I think people quite often just assume that if something were to go wrong, it would just continue on, or the government might look out for them. But the reality is that unfortunately, that's not the case. What you will find is that quite often WorkSafe or work cover won't actually be covering you to the extent that you feel it might. You might feel that your employer's got your back, but the reality is you should at least be looking into these things before you just assume that or have any false assumptions about what you're actually covered for. At the very least, you should be reviewing and making sure that in the event of something going wrong, you want to know that you and your family are covered for pretty much what you would expect to earn for the rest of your working life. So if you're planning on working all the way through to 65, if something goes wrong, you want to stay on that track to still be able to, yeah, earn an income right up until that point, not have it cease a couple of months after something goes wrong. So you can see there on the slide there, it's mentioning about who depends on your income. That's a really important point. It's one of those things. If something happens to you, it's not just you that you have to think about. If we take an example of a young family, for instance, that whole family might be reliant on the breadwinner, which might be, say, if it's the husband and he's working a 9 to 5 job. Without his income, their whole world is in a state of disarray as well as yours. So you're talking more than just one person being affected. It's actually a whole thing the whole family needs to concern themselves with because at the end of the day, it's not just the husband, not just the wife, but the whole family and their ability in the future to be able to do the things that they were planning on doing. So it's really important to make sure that when you're thinking about this sort of stuff, you're not thinking about it just for you. It's actually you and your whole family, and that's really what you need to concern yourself with. So I'm just going to touch over the page now. You'll see here what I wanted to do is show you a little bit of an idea about how much money we're actually talking about. You can see there a 45-year-old earning around about $60,000 today still has the capacity to earn around about $1.6 million before they retire. That's assuming they retire around about 65 and their salary increases about 3% each year from now on. You can see as we start to deal with people that are a little bit younger though, say a 25-year-old right now, the capacity they have to earn something closer to around about $3 million before they retire. So I would argue that that's pretty important to make sure that for their sake and their family's sake, they have that money coming through regardless of whatever hurdles life might throw at them. And you don't want to leave the whole thing up to chance where you're taking a punt on, well, hopefully nothing happens, but if it does, I'll have to deal with it at the time. Rather than do that, you're better off actually having the approach of being proactive and saying, well, let's just put some steps in place now to make sure whatever life might throw at us, we've got sufficient insurance in place to actually cover off on anything that may come up. So that's a really important point to touch on there, because quite often people won't worry about this stuff until it's already occurred, and then they'll start thinking, why didn't I do this then, and how come I didn't think about this sort of stuff. But take the risk out of the equation and put adequate insurance cover in place. You'll see here I've just gone over the page. I want to touch on a few points here that are a good way of starting to have a think about, would I be affected if any of these things happen to me? And you can see a few of the points there. They're pretty morbid things to think about, but point number 2 there is a good example. What would you do if you lost your partner? I mean, for example, even if the partner's not the major breadwinner in the family, in all likelihood, the one that is out earning the money isn't going to be able to continue doing that if they don't have their partner around anymore. They're more than likely to have to scale back their work hours. They're going to need something in place to make sure that as to the way your life works from now on, and it more than likely isn't going to include the same amount of work that you were previously able to do. So you can see there's a few other points there. Not all of them relate to income protection, and even just that spouse partner scenario I just gave you, it's probably more to do with making sure the partner's got adequate life, TPD and trauma cover in place. But you can see just how important insurance starts to be in terms of making sure the family can stay on that track to retirement and to achieve the goals and aspirations they were wanting to take out of life. And if you don't have this stuff set up, it's going to have some pretty dramatic implications to you and your whole family. I guess just to touch on it, a lot of people ask what is insurance and why is it set up. The easiest way to explain it is it's a group of people collectively pooling money together. And they're pooling money together because they know that not every single one of them is going to have one of these occurrences take place, but themselves over to the insurance provider, and that can give people a great sense of relief and peace of mind. It helps to at least alleviate concerns, financial concerns I should say, with things when they do go wrong, whether that's accident or illness. So if you've got your financial situation in a good place while a family member's suffering with a particular illness, whatever it might be, at least from a financial point of view, at the same time you're not worried about mortgage repayments, you're not worried about how you're going to pay for the medical costs. All that stuff is taken care of, and it really is just a small price to pay. So that's the reason behind it. That's why people have it. And I guess the crux of it is, you can see that last sentence there. It's a means of protecting your wealth, assets, income, life, dependence, health, and future plans. And that really is what it's all about. It's worth mentioning today we're really honing in and focusing on personal insurance, but the other insurance types out there are all really designed for the same purpose. And whether you're talking health insurance or car insurance or whatever it might be, the main reason people have insurance in place is to pool their money together and spread the risk so that if they do have a car accident or their home gets burgled, they've got a small amount to pay rather than a $6,000 car repair bill or whatever it might be. So those are the main insurance categories there, but today we're really just going to focus on personal insurance. Within personal insurance, you have a range of different types of cover as well. You can see there life slash term insurance. Sometimes you'll also hear of it as being called death insurance. Pretty self-explanatory. What it does is pays out a lump sum in the event of death to your spouse or to your estate or whoever you've actually set up as the beneficiary. The next one there is TPD, or Total and Permanent Disablement Insurance. What it's designed to do is pay a lump sum in the event you're rendered unable to return to the workforce. Following that, the next one there is Critical Illness or Trauma Cover. That will pay you 14 days after the specified illness occurs. So you're talking things like heart attack, cancer, stroke. It is feasible for someone to suffer one of these illnesses and still return to work 3 or 4 weeks later, having suffered, say, a heart attack, and still receiving the proceeds. Income protection, the next one there, is designed to protect your income, obviously, and preferably all the way through to retirement. And the final one there are the different types of business insurance a self-employed person can have. And a lot of that's to do with how the business has been set up and structured, and the particular conditions of the self-employed person. So we'll touch on that a little bit later. Just next slide here. This is a few pretty morbid facts about cancer. You can see there, well, all the dot points really are pretty scary stuff. You can see that second point there. It's a flip of the coin. If you've got a partner, one of you will suffer from cancer by the time you turn 85. It's the leading cause of death in Australia. And you can see there in 2010, more than 43,000 people lost their lives from it. So really important. That's just one condition, and you can see how common it is there and the different forms of cancer. You can see prostate, breast, melanoma, lung cancer, and bowel. So yeah, it does happen, and it's important to make sure that with some of this stuff you're not just glossing over it, because the fact is it's a reality. It does happen, and you need to make sure that you're covered for it. We spoke a little about life insurance already. So it covers you off in the event of death and pays your estate or your spouse or whoever you've specified within your policy. Some super funds out there will give you a default level of cover, and it's usually not enough. Quite often they'll give you units of cover, and that tends to be, if you're lucky, maybe $100,000 or thereabouts, maybe a couple of $100,000. But really, with life insurance, you want to be making sure that you're covering off enough to cover the family, to pay off their mortgage, to still send the kids to the school that they were going to go to, and all those sorts of things. And usually the default level of cover is nowhere near enough. You can see here some of the reasons you have life insurance. Obviously paying for the costs when someone does pass away, legal expenses, clearing debt, and most importantly, replacing the income that you would have been able to receive otherwise. A person that dies actually would have been in a situation where they would have been able to earn income for X amount of years. Now that person's no longer around, you need to compensate that family for the fact that the breadwinner's no longer here. So you need to make sure that you've got enough insurance cover in place to leave your family in a good financial position to keep going with the plan of attack that they had in place, and not leave them in a financially burdened situation. So in terms of who should consider life insurance, I would say the majority of people should have it, but in particular, you've got anyone that's got kids, anyone that's got debts, and anyone that needs to. They're not in a position yet where they're ready to. They've got enough money to cover them, whatever life might throw at them. So you need to make sure that you've got enough cover in place to keep your family on the same track they were heading down before you left this world. So businesses also have a need for life insurance. What they tend to have is key person insurance, or it can be used for succession planning, where it's particularly important. What happens if you've got a partnership where you've got one partner that suddenly passes away? The other partner needs to be sure that there's insurance in place to either be able to basically keep the business running. Otherwise, quite often you'll see business owners will actually take out policies on each other's lives because they want to make sure that able to pay out a partner's wife or whatever it might be. So it's really important that gets thought of. In terms of total and permanent disablement insurance, we spoke a little bit about this already. It's designed to pay someone out a lump sum if they've got no chance of ever returning to the workforce. People tend to have this packaged together with life insurance just in case they have a situation where they get paid out one or the other. So if they've already got a illness that will take their lives eventually and they've left the workforce with no chance of returning, they may get paid out the TPD before the life cover while they're still around. So it can be handy in that respect, but yeah, it's very hard to claim on, especially if there's a chance you'll ever be returning back to work. This next cover, trauma insurance, is where you will actually be able to do that. So any of the specified events on your policy, if you've got a particular condition that's covered, you can be back working again not long after suffering from it. You'll see there's around about 40 specified conditions on most trauma policies. The 5 main ones there make up 80% of all trauma claims, so you can see just how common those 5 are. We'll just touch over the page here. So in terms of why do you need it? Well, when one of these things occurs in your life, the last thing you want to be worried about is financial issues. So it could be that you want to remove any financial stress. It might be the money's required to rehabilitate yourself. In some cases, it might mean you might need to actually travel overseas to go see the specialist for the particular condition that you've got. And if it's a particularly bad illness, you might need to start taking steps at home to renovate to make it more easy for you to get around at home, or your car might need to be modified. So there's a whole range of different costs that can come up. Who should consider trauma insurance? Well, it's really particularly same as the income protection, really. It's couples with kids, anyone with a larger level of debt. The last thing you want once you suffer from one of these conditions is to have large debts, kids with school fees, and all these other financial issues that really got to be sort of put to the side when you're dealing with this sort of illness. The other area where it's really important is if you're not working, so if you've got a husband or wife that's unable to get income protection because they just don't work, they might be a stay-at-home mum or dad. Trauma insurance is really important for them because, to be honest, without income protection, you need to compensate for the fact that they can't have that. And even if they're not the breadwinner's more than likely going to have to start taking time off work to start helping the family. So really important that it's a consideration for all those different dot points there. In terms of income protection, you can actually insure up to 75% of your salary, and this will cover you for accident and illness. The benefit period can be a range of different periods. I would typically recommend most people, in the majority of cases, go to age 65. It's really supposed to be designed to pay you all the way through to retirement. So for most people, age 65 is going to be a better option than a 2 or a 5 year benefit period. So why do you need it? Well, it's there to basically keep you on the same track that you would have been on if you hadn't have suffered from the illness in the first place. Your family and your household's expecting that income to continue to come through. Mortgages still need to get paid. Car loans still need to get paid. Ideally, you'd like your super contributions to still be going in. The electricity bills are still going to arrive in the mail. So income protection is designed to basically keep, from a financial point of view, all things being equal, on the same track they were on. So that's why you need it, and that's what it's designed for. Um, who should consider income insurance? Really, anyone. Again, the young family is a good point, but anyone that is earning an income that has commitments, and if you're no longer working and you're no longer receiving an income, then someone or something's going to have to pay for those commitments. So income protection is there to help you out in that respect, and that's really what it's designed for. There's other, I suppose, options within income insurance which makes it either cheaper or more expensive. The waiting period's a particularly important point. The longer you can wait before the income protection kicks in, the less expensive it'll be. So for some people, they need to have it quite quickly because they don't have adequate sick leave in place, or they don't have a cash reserve set aside for a rainy day. So those sorts of people you tend to find would have, or have a need for it pretty quickly. But if you're in a situation where you don't necessarily need the income straight away, you could afford to have a waiting period that's a little bit longer, and that's one way of making it more affordable. As I already spoke about, benefit period can pay you as short as 2 years, but in the majority of cases you're going to be wanting to have cover all the way through to age 65. Agreed value or indemnity cover. Indemnity means you're basically getting paid whatever your salary is at the time up to what you've insured yourself for. Agreed value, it's actually set in stone, similar to car insurance. It tends to be about 5% more expensive, but you've agreed to whatever insurance is in place. So if you're a self-employed person, for example, agreed value tends to be the better option because your income might be quite volatile, and you have a really bumpy year, then a lean year the next year. You don't want to be in a situation where if you've gone down with something and it's a gradual thing and you finally make a claim but you've got no income to show at the time of claim, they might end up putting down your benefit if you're under an indemnity contract. So agreed value tends to be the best way for self-employed, but again, it's not clear cut for everyone. Another thing that we should really touch on is, before entering into any insurance contract, you want to be sure of some of the key definitions that are on that contract. A lot of it can be found in what's called the product disclosure statement that will be provided for you, but basically the things you want to look out for are whether or not there's any exclusions on your insurance policy. Quite often it's just unfortunate that your health may already be suffering before you take out the cover. Therefore, there may be particular things the insurance company wants to either exclude, or they want to load your policy, which means they want to make it more expensive than someone that didn't have that particular condition. And there's different definitions about what total and partial disablement might mean. So all those things you want to be quite clear on before you enter into an insurance contract, and that's something I can go through with you together. Premiums for income protection are tax deductible. That's something we should make a point of. This is particularly handy for someone that's a high income earner that might be on $100,000 plus per year. There's potentially savings there of around about 37%, because that brings down their assessable income by having the income protection in place. So if they can afford to have it outside of superannuation, that tends to be the way to go for them. As I just go to the next slide, you'll see this one is all about ownership of your policies and whether to do it through superannuation or not. Some things, I guess, that are pretty clear cut. Trauma insurance should pretty much never be held through superannuation. There's very few instances I can think of where it would be the way to go. As for the other types of insurance, they can all be held either inside or outside with different reasons, one way or the other, and it's one of those things, how to best structure things in terms of your insurance situation. I suppose just concluding just today's slideshow, I think these three key points on this slide are really important. This first slide up here, many people are underinsured. It's actually 6% of Australians have adequate insurance cover in place. The other 94% have left themselves short in some aspect of their insurance package. And I hope today's presentation's given you some insight into just why people should have insurance cover in the first place. But you can see that point two there. It's I guess the key reason is what it's designed to do is to transfer the financial risks to an insurance company rather than leave yourself open for what could potentially be the difference between your family living a good financial future and being destitute in a worst case scenario. So the third point there I want to touch on as well, it's really important that you start to think about it's not just you that you're putting at risk, and it's not even just your family, it's your immediate family, and then also you're talking grandparents and things like that. If a young family goes down without insurance cover, it tends to be the grandparents that end up having to try and pick up the pieces in an event where they've just got no insurance cover. So quite often a lot of that gets overlooked, and the person who's not really, or is a bit cynical about insurance, might just think, oh, well, it's not going to happen to me and I'll worry about it if it does. But it's not just you're putting at risk, it's your immediate family, which might be kids, wife, but not only them, it's brothers and sisters, your parents, and any other friends and family that are close to you can all be affected by you not having appropriate cover in place. So just over the page here, a quick disclaimer. I think it's really important if you're wanting to learn more and wanting to find out if it's right for you, if you've got adequate cover in place, I really urge you to get in touch with me. I will have details on my YouTube channel of how to get in touch, but I really urge you to start looking at this as a part of your life if you haven't already done so. And I hope that you've been able to take a lot from today, and thank you very much for your time.